Everybody liked the bacon. All right, so I'm going to jump right in, I think. Oh, that went too fast. So I left the end of this presentation for some Q&A because I always know there's a bunch of them. But just real quick, we're going to step in and like quick video about what happened in 2018. What's that video? You guys run that video? Video's tough. Improv. There really is a video, I swear. All right, we can skip the video, guys. It's fine. We built a lot of stuff in 2018. No, so really it was just a video snapshot of all the projects that were going on all year that Laramie and his team and Wayne and his team were working on. But we're building consistently over 100 megawatts a year, right, across the portfolio, just in the U.S. With Europe coming, we're going to be looking, probably within the next 2 years, being up over 200 megawatts a year in a portfolio. As Di mentioned, we are spending a ton of money doing that. Even though we're kind of low-cost provider in the market, we're building a lot of stuff. Just to put this in perspective, and I always like to go back to this, my first year at CyrusOne, the entire construction budget was $125 million. We spend that in less than a month now. So it has been amazing growth, and we got a huge team of support, obviously from Di's team on the procurement side and the finance guys, getting the money we need and driving value in across the procurement side. I'll just keep going. So the next slide in my deck was a presentation, or a slide of my direct reports, my team. So Laramie Doris, obviously Mr. Giddy Up, construction. Phil O'Dwyer, guy who runs our operations. Wayne Lunsford, our crack design engineering team. Jimmy Roach and Rob Bruno, who you all better know very well. So give them a huge round of applause because I'm not Mr. Anything without these guys and the guys that support them. So, and obviously Cheryl, I don't think I could survive here without Cheryl. So she's making sure all my reviews are done and you guys get your stuff needed. And I know Caroline especially knows exactly who to call when she needs something from Hatem, right? So, and Cheryl won't let it go. So hats off to Cheryl too. Stepping into what's available. What can we sell now? This is the big question. This is what we're going to talk about. Okay. So Northern Virginia. We have one late addition that didn't make it into the slide. I made Laureen wait until literally the 11th hour to get my slide, and I still had to change. But we're going to have 1.5 megawatts available and 20,000 square feet in the Concora building to support those enterprise deals that are sitting in that market right now. So Laramie and the team got really creative, found a couple more slots for some gens and electrical rooms, and carved out 20,000 more feet in Concora. Yeah. So hopefully we don't have to build them people in a closet in Shaw Road, which would be good. But that'll cover us, for, I think there's 1.8 in the funnel. So, if you guys close it all. All right, I really can't remember exactly what was on these slides. I'll work on it here. So K3, K3 is in planning, right? We had to move some wetlands and move a stream, but that building's coming. And it's going to be 90,000 square feet, so it'll be three floors of 30,000 square feet, 6 megawatts each. And that'll be coming towards the end of October for the first 6 megawatts. Right now, that's in the plan for the first 6 megawatts. Obviously, signed deal, we could, obviously pull some things in if we needed to, but right now that's the high-level schedule for K3. Building 2, this 30,000 square feet, 4.5 megawatts, which we all love to talk about, is the Google Rofer. And I still think with everybody in this room, nobody knows when that Rofer's up. But I heard June, that'll come available for space. And so Matan, we're underway at Matan. Matan was a brownfield building we bought, for those of you who don't know about it. It's 120,000 square feet, 24 megawatts available in April. And when I say available in April, the first 4.5 megawatts will be ready. And obviously, we'll time that capital spend as the deals come in. But just so everybody gets it, right? So once we have that shell and we have the site ready and that space is ready to get built out, we'll sit in front of a customer, obviously, and it's 12 to 14 weeks, 16 weeks on the long side that we could have that power and space available for the customer. And that's the long pole in the tent. Those are the conversations we have with Gary, right, about how far out on spec we're going to go on land and shell, right, so we could be proactive when it comes to deals. Tolson, new property in Northern Virginia, a monster build, monster campus, 400,000 square feet and 90 megawatts available. It's going to be sometime in Q4, right? So we're toying around with October or December, but sometime in Q4 we'll have the first bit of capacity available there. So that's a lot of, I put the total up there for Virginia. There's a lot of stuff there. That doesn't even count the 1.5 meg or the remaining capacity at Shaw Road. And it's little, if you see that picture on the bottom, that's Kincora. It is a beast of a building. It is a monster. It is all the things that we've learned, right? That scale helps us and big shells help us and, all that thing. So obviously Virginia was the first place we started doing those that was kind of the evolution of the Cloud Center, right? And seeing what we could do there. So moving on to Phoenix, the big number at the top, Phoenix, we have 1.2 million square feet of capacity theoretically that we could get built in that market. A big chunk of that is in Mesa. The substation work is underway right now, but Mesa is another huge campus. We'll kind of make the existing Chandler campus look small by our standards. So building 2, there's 60,000 square feet in shell-ready condition right now. That could go up to 13.5 megawatts. Building 8, 8,000 square feet and 1.5 megawatts. That is ready now to sell. Building 10, we did get approval for that shell. That's those pictures that you guys see there. That's a precast shell, just like Northern Virginia, 2 stories. It's the Cloud Center Light product. That shell comes complete in April. From that point forward, you guys are 14 to 16 weeks out from capacity. So we had a slow year in Phoenix, as Gary likes to keep reminding me every time I ask him for money for Phoenix. So let's get something sold there this year. It'd be good, Johnny. And Building 9 is a sister building to Building 10. Same Cloud Center Light, 160,000 square feet, 36 megawatts. And that shell will kind of get released once we have some capacity leased up in Building 10. Any questions about Phoenix or Virginia before I move on? We can just hit them now while they're. I couldn't hear a word of that. Oh, let me repeat the question because I could really. So the question is, at what point do we start Mesa, right? Depending on the what's going on in Chandler. So the initial play for Mesa was that we had customers there who wanted to be with us in 2 sites, right? So it could be a combination of, okay, listen, is Chandler going to be 100% sold out before we start in Mesa? Probably not, right? We're looking for a customer who maybe is in Chandler today to say, I need a redundant site with you guys, and that would kick off a build in Mesa sooner than, you know, depleting the capacity in Chandler. Okay. I'll talk about it. So this is a video that's not going to play either, but this is the start of the video, so at least we can see the picture. I made the presentation, so it's only me to blame. But you see Building 10 over kind of on the high side of that picture, and that's what's getting built right now. And the Chandler campus, for anybody who saw it when we started, it's grown immensely, and it's a cool picture. Let's see, is it? Oh, not going to work. All right. So moving on to Texas. So Allen Building 1, obviously we have a nice open house there. There's 60,000 square feet, 4.5 megawatts sitting there ready to go right now with capacity. And obviously we have shell capacity if there's a unique deal that we need to get worked in there. Ultimately, that building will go to 120,000 square feet and 18 megawatts. So that's shell ready space. And the rest of the buildings out on that campus get us to 450,000 square feet and 90 megawatts. So we went from Louisville to Carrollton, which, you know, was 10 times the size of Louisville, and now this will probably be about 10 times the size of Carrollton. So Houston, for all my Houston brethren out there, we got space and power ready to go, and our OData folks for our oil and gas customers. So hopefully we start making a dent in that. And the shell that's there for Building 3, so that shell-ready space is that 210,000 square feet and 31.5 megawatts that we could build into. Austin Building 3, we have 30,000 square feet and 4.5 megawatts, more or less on the other side of the building that's not built out right now. We have some prospective customers for that. The design's getting worked on right now for that side of the building. And we recently got approved an additional 3 megawatts of power for the legacy side of that building to backfill customers like Samsung and all that stuff. So I said 3 megawatts. We're literally building 3 megawatts of capacity with the ability to step that up to 4.5 if and when we need to, quickly, right? The challenges in Austin for us is building permits. So we're having a huge kind of 4 to 6 month wait on getting a building permit for Austin, which makes obviously our build timeline twice as long, if not longer, because we're waiting on those permits. So Di graciously gave us design money so we get that process started sooner, and that's kind of going to be the path we're going to have to go down for Austin. San Antonio, I think the project development team mentioned it yesterday, but we have more land coming and more capacity, and we're going to see if we can sell a different customer into that campus. It's as well as Microsoft. So I got my sheet from my guys before I did this presentation, and there is some square footage available in that building right now, but we are power constrained. And we have a floater yard that just got completed for data halls 2 and 3, more or less. And there's another floater yard that's getting built right now that's going to bring an additional 4.5 megawatts to, you know, the 6-7 side of the building, the data hall 6 and 7 side of the building. So that'll free up power. That'll help with some of the regrooming we need to do with USAA and Equifax and some of the customers who had an issue. But yeah, I mean, we need to get this power thing. We need to get this power added, and then you guys could go hog wild. But more or less, there, and Jimmy or Bruno. So, I mean, you guys more or less, we're not selling into Carrollton any kind of new logos at this point. Nope. It's all, everything that's there is for expansion of existing customers and existing growth. So, we want to push. I mean, here's the thing, right? We got to get people into Allen, right? We got to get people into Allen, and we're not in the business of giving stuff away for free, obviously, but like if it's cross connect, it's a bandwidth, if it's any of those things, like we have to make that transition easy for them, right? And even for customers growing in, obviously, in Louisville, where we're, you know, these sites are kind of full. Like, it's a shuffle for the ops team, right? These guys are going to shuffle around whips and PDUs, and, you know, this customer's down and this customer's up. So I know it gets a little frustrating on your guys' side sometimes when we're saying just go sell, 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 and then the ops team says, oh, don't sell that. But that's what it is, right? I mean, these legacy sites were constrained on power because you guys did a great job of selling them out, and now it's literally, you know, it's a shell game of what we're moving around for who. Yeah.
I don't know if you guys can hear me. When that's available, let's really aggressively sell through to our existing base. I know, where's Ashley? I know we have some, I know we have a mixed audience here. We have a number of key customers that are gonna wanna finish out while they can leverage their existing networks. Let's make sure we do it, because we really want Carrollton to be a 99.9% fully, you know, fully functioning asset for us financially. Okay, thanks.
Thanks, Johnny. So stepping through the rest of the portfolio, Chicago's got space power, plenty to go. We have room for another building out there. So that's, we'll see if these Coinbase guys can really pull in a bunch of folks. That was a great logo to get. The Atlanta coming soon. We have dirt, right? We're looking for a deal to kind of do a build to suit in that market. And Kevin touched on Santa Clara and Quincy yesterday, so I didn't want to kind of rehash that stuff, but both big footprints in those markets. And you know, Quincy, I mean, just for everybody's, you know, so everybody gets it, right? So in Quincy we have permitting issues, right? It's air permitting issues and you know, utility issues that we're working through in those markets. They're different than Virginia and Texas and, you know, even Chicago, right? So we start these projects long before. We're telling you guys about them for what probably feels like forever. And, you know, the time will come, like we'll hit those milestone marks and we'll be able to, you know, get those things off the ground and going. Just takes longer. It's a little bit like Europe. All right, so what's changing? So any questions on capacity, like in the market? Man, I can't hear him. Did anybody hear that? Hang on, Jason. Come on up, buddy. No, it's
So with Austin Met 3, the current deals that are in place, should they sign soon, what is the timeline for more inventory? I know it showed there that we have land, but what's the time for you guys since the process is so long as it is?
So just so I got that, so in Austin Met 3, if we have a customer who's in that building today who needs more power, how soon should they sign?
No, if the shell space gets sold to USAA,
Yep.
for example, assuming they take that, what's our time frame for more inventory to have available?
It's probably about 12 months. So I left that part out for Austin. We still own a piece of land across the street. If USAA goes and they take the rest of that space, we will kick off the design for the rest of that shell space. You know, if we just go back to the permitting process, we got 6 months or so of a permit, and then we probably got 6 months to get a shell stood up with power in it. But it is right across the street. It's next to Austin Met 2, and we've been holding on to that land for a long time, you know, just in case we got to this point. So anything else on the capacity side? Norwalk, going in for capital committee approval today.
What's the minimum, or what type of deal are we looking for in Atlanta? Like, how many megawatts do we need to necessitate the build there?
I mean, we're really looking for like you need a 4.5 meg deal, right? To make a standalone site make sense, right? You need to have, it's 4.5 meg, right? And it's a bunch of things, right? It's obviously, it's really inefficient for us to build 200 kW in a brand new building, right? But there's the whole operational side of it, right? Like below 4.5 meg or below 4 meg, you really can't even cover the costs to operate the building, right? To staff it 24/7, to have the operations staff there. So you're really looking. I mean, I know that's a large deal, but 4.5 meg is kind of the trigger to get you to the point where, okay, we got a footprint. We could get this thing built for a reasonable amount of money. Will obviously give us that shell will give us runway in that market to add more, but on an initial tranche, 4.5, and the boss is right there. So, what do you think? I mean, that's pretty much what we think about, right? Gare, I'm talking to you. I wasn't asking Laureen.
Just to steal Hatem's thunder for a little bit, who can tell me how much available capacity we have built out that is sitting around the country? Ashley. All right, next question. Dorico. How much? 50 megs. What about square footage wise? 500,000. 500,000 square feet of capacity we have invested, which is hundreds of millions of dollars. And we have done that based on everyone's information that we put into Salesforce. We have allocated hundreds of millions of dollars of capacity that is sitting out there. Don't think about what we're going to do for our next building and go do that. What we're going to focus on is selling what we have and what we've built out. That's the priority for everyone here. You've got to get your head around that. Capital is not unlimited, and it pains me to kind of say that, Di, but when you are spending $1.5 billion a year in capital, you have got to be really, really focused on selling it out. We've got fallow space sitting in Houston for 3 years, sitting in Chicago for 2 years, sitting now in Allen and Dallas for a year, in Phoenix for a year and a half. So we have spent hundreds of millions of dollars, and we can't continue to do that. We've got also initiatives going underway that we are spending hundreds of millions of dollars into Europe to build out a portfolio. You've got to focus on selling what you have and not what you don't have, and get your head around that, because we have spent an inordinate amount of capital. And the way that kind of comes out and manifests itself in our financial results is on our FFO per share. So when you look at our high-level numbers, what you're seeing is really magnificent growth rates. Revenue up 20%, EBITDA up 20%, FFO up 20%. Where you're seeing anemic growth rates is FFO per share. And that is probably the most important metric that all of our investors look at. And the reason that the FFO per share number is really low is because when we spend all this capital, we have to issue equity, and to the extent you get more partners in a deal, you divide by a bigger number, and that obviously makes your per share number smaller. So that's the focus. So you have to get around, so we're willing to put the capital. We've been spending, as Hatem said, we did $125 million when he first joined the party. We're spending 12 times that now. But we have to be really, really efficient when we're allocating it. And so when you put those numbers in Salesforce, we are expecting that you're going to deliver on that. It's not a free ride, and that's what's going to happen. Like this year, when we came out with our results in 18, all our numbers were off the charts, great numbers. The only anemic number that we had on there was an FFO per share of 5%. And so these things are really important. If you go through all that, we have portfolio all around the country. We are going to be allocating money to Santa Clara. We're going to be expanding into Europe. But you can't do that unlimited. Like, you have to focus on selling what you have and not focus on what we don't have. We got what we got, and we got a whole bunch of it. And that's what we need your help on more than anything else, rallying around, trying to sell out all the capital that we've invested, because that's going to give us the best return on. And if we sell that out, then we're going to do more. But if we don't sell it, then things start to slow down. And so we've got to be really focused on how we allocate the capital, and that's all contingent on all the information that you put into Salesforce that we make real decisions on. So like later today, we're going to have a capital decision, make some additional capital investments. But there's critical questions that are saying, if you want the money, what are you going to do? Do you own this? Are you going to deliver or not, right? Because we can't continue to just have all of these investments around with no customers in it. So sorry to kind of like put a damper on the party, but you got to understand that like there is a real cost in everything that we're doing, and we are spending an inordinate amount of money, and we need to continue to grow. So anything you put in Salesforce is really important. We make real decisions on it, and you have a commitment to us when you put that number in there to go deliver on that number, because that's what we're assuming you're going to do. All right? Thanks. All yours, Hatem.
Thanks, boss. So just to dovetail into that thing with Gary, because we've been talking about this 500,000 square foot number for a while. So listen, get it. Those are in markets. Maybe there's not a lot of activity, but like we are here, right, to make a deal happen in those markets. So I know we have a thing come up with a customer who wants certain kind of fire suppression in Carrollton, right? Like everybody on my team, operations, sales engineering, construction, like we are here to make those things work for you. So, if there's a customer who has a unique situation in Houston or Chicago or Allen, right? And it means we could get a deal signed into those, we are here to help those things happen, right? Okay. Moving on to the fun stuff. So what's changing? So we've come up against some limits, as I'm sure some of you know, on the density front. Customers are coming in with real loads pushing past 17 kW per rack. So we need to support these higher densities. The cloud companies, we're looking to take those guys to a no raised floor solution, right? So once we take raised floor out, our delivery of air becomes much easier. We switch over to hot aisle containment. Where the break in this is really between your hyperscale cloud guys and your enterprise folks. Your enterprise folks still kind of need to be on raised floor, want to be on raised floor, and their densities allow that. The challenge on the construction side for Laramie and the team is I need to tell them when we start, what is this building going to have, raised floor or no raised floor? But that, for our cloud guys, go forward, we will be transitioning to a no raised floor environment for those. And that'll be hot aisle containment, that'll be a drop-in ceiling, and hot air plenum back to the Cray units. And there's no real... So what happens when we have raised floor, all our cold air comes up from that floor. You need a certain amount of air to cool the server cabinet. The issue is once you go past 17 kW a rack, your cold aisle needs to go to 8 foot wide, right? So this is where this gets super inefficient. So you need an 8 foot wide cold aisle that you need to contain to cool that same footprint, right? And once the loads are actually there for years, like, people are going to run 20, 30, and they never did, but we're starting to see those loads in real life. So that's what the constraint becomes on the raised floor. Once you take the raised floor out and you just fill that room with cold air, you have more than enough CFM, you can keep 4 foot aisles on both sides, and you duct your hot air up into the plenum. So efficiency, containment is all kind of stays the same, it just allows you to cool 20, 30 kW in front of a rack. And we don't have to worry about getting that air pushed up through the floor. So we had this debate. We had an offsite. We were talking about it. And, Equinix has been no raised floor since the beginning. And they do single cabinet deals. So we should be able to do that in our enterprise side, too. But we'll make that a slower transition as some of these new shells come up out of the ground. So it all has to go overhead at that point, right? So it's funny thing is, so it's like that's a good question. Like we have a ton of power and stuff underneath that floor, right? All that stuff has to get moved up. So it's not a cost savings thing for us. You're really just taking out that floor and spending more money overhead. But if there was an enterprise guy who needed water cooled cabinets, like a Cray, like that has to be a raised floor environment, In any one of those cloud center shells. So it could be K3, depending on where we sell that in the pipeline. Matan was designed as actually both. when we were looking at Facebook. That was designed for Facebook as a no raised floor environment. And then we have that optionality in the Phoenix shell, and we'll have that optionality in Tulsa as well. So yeah, that's not a me question. Yeah, we should have a separate conversation about that. Any other questions on the higher density stuff? Yeah, I mean, we've done it all, right? I mean, we've literally had deployments of oil bath, mineral oil, you know, servers laying down on the floor. I mean, we've done them all, right? We have a bunch of them still in Houston. So, I mean, there's nothing that my team can't talk about, and either that we've done it or have experience, you know, somewhere else doing it. So, but it, yeah.
So we've had these discussions before about the more automation you put into the building, the more risk you have, the more complex they are, they outthink the operators. But as we aggressively pursue AI, what are we doing in terms of looking forward to the future with automation to the buildings, and how, to what degree can we harness AI to operate more efficiently? And you know, what are your thoughts on that?
So we're definitely seeing AI come and fruit to bear with AI on the ops side today, right? So a lot of the tools that we pulled in from CBRE, they're starting to leverage AI on a proactive maintenance perspective. I mean, they have systems now where they have literally microphones on every piece of equipment, and you know, a computer could tell if something changes that a guy could never tell, right? So you can see an error long before it happens. So we're definitely seeing that come on the operations side. And we need it, right? I mean, we're manning these sites with 10 guys, and we're looking at 90 megawatts across 3 different buildings, right? Like, we need all the intelligence we can, you know, without, you know, and putting one guy in one spot. So we're definitely seeing that on the ops side. What Mark Cuban was saying about, you know, designing a better data center, we haven't seen anything. I mean, we haven't seen anything like that yet. But I think there'll be more on the, there's a couple of things. So lithium ion batteries are coming. This is in the deck later on, right? So lithium ion batteries become smart batteries for us. Just like the battery in your phone, you can pull all this data up. So once we make the switch to lithium ion batteries, we're gonna literally have eyes into the exact power utilization, the power factors that are happening, and AI is gonna help make decisions about how we change frequencies to get more efficient on the UPS, right? And you're gonna see the same thing on the chiller side. It's at the component level we're seeing those things with our manufacturers and some of the components, and the prices are starting to come down to where we could actually leverage these things. But that's really where we see it. I mean, as far as the demand from AI for our facilities, you know, we're not seeing anything, we're not getting asked for any kind of different data center because of that. Your question is really how we leverage AI for ourselves, and that's really what it would be. So, I'm probably running low. How am I doing on time? It says I got 30 minutes. Oh, now it says 0. All right, so moving down, so block redundant, so you guys, everybody knows we do 4/3 distributed redundant. We get 75% asset utilization, right? So we get to take all that capacity, 75% of it we get to lease out, and we were kind of first to market on a hyperscale perspective to do that, which kind of pushed all the 2N guys, you know, back on the cost side of it. So what we're seeing is a lot of the people in the market are now willing to accept higher ratios, right? So we have a 6/5 design. We have, you know, we're kind of maxing it out at 8/7, right? So this is not probably going to be appetizing to the enterprise folks at all, right? But when we need to deploy 45 megawatts or 30 megawatts of capacity to a hyperscale guy, these are the designs that these guys are accepting today, right? So we all have a design ready to go. And I mean, just to put that in perspective, right, we go from a 75% asset utilization to an 87% asset utilization, which by just a straight up math, right, I'm reducing our build cost just by going to that ratio. We still offer the same SLAs with that. You know, an educated customer will know that the resiliency is not the same, but if they're willing to accept it, we want to have those designs ready to go. Upgrades to BMS and EPMS systems. So Caroline, to the AI thing, there's that piece, but there's also, there's some underlying infrastructure changes we need to make on the BMS and EPMS to, and this is with Blake's team, where our customers want to see everything, right? I mean, they want to see the temperature, they want to see the humidity, they want to see their power at the cabinet, they want to see the PDU, they want to know if the utility's up and running. So, so on the construction side, which really funds all that work, you know, for all of our new builds, we're going to start piping those things in, right? So we could more or less turn these features on and off for a customer. And you guys should start seeing the fruits of that, you know, by, you know, within the next 6 months. Solutions engineering, so to Rob and Jimmy's team, so we're expanding our CFD capabilities, so we're getting more computers, we're getting more people to start doing that, so that'll stop slowing down that process as much as possible. The SE team has also offered to train their guys to do CFDs, so we'll get those things sped up this year. Data center husbandry, and this kind of goes back to the 500,000 square feet. We have spent years, right? We have drawings in Salesforce, we have drawings on, you know, OneDrive, we have drawings all over the place of these facilities. What's available square footage, what's available power-wise. So in combination with sales engineering and the ops team, who need to report this data to the finance group, we are going to standardize that once and for all with a drawing per market, per site. One person's going to own that drawing, and that's going to tell us exact power, cooling, and all of the back and forth around. Two guys are looking at the same space. We'll take that away. But I think the important part is we have 500,000 square feet to sell. Is it 501 square foot spots that we have to sell, or is it, you know, what's contiguous? What can you actually sell to your customers? Is going to be the key, and that's going to come out of that effort. And we have more recs for more solutions engineers coming in 19. All right, so we continue to go green. So we touched on the batteries, so I'll just start with that. So we are making a huge push to get to lithium-ion batteries on the UPS side. The batteries are surprisingly, you know, what we depend all of our livelihoods on is a bunch of car batteries that sit in a cabinet today. So we want to have smarter car batteries that sit in that cabinet. But lithium-ion does a bunch of stuff for us. On the green side, no more lead in our batteries, and also these batteries last 10 or 15 years opposed to the batteries we buy today, which last 5 years. They become much more intelligent. They can actually peak shave off that UPS, so they could, you know, help us on our utility side, where we could shave, you know, our peaks off from the utility and use that battery on a regular basis. They don't degrade like lead acid batteries that we have today, so they actually become part of the infrastructure that we could use on a day-to-day basis. They're way lighter, right? So if you want to make the whole pitch, they're about half the weight of the batteries we buy today. So we save shipping costs, we save shipping fuel, and they're way easier for Laramie and team to get installed. So, so hopefully this year, last year we really tried an effort and we were still seeing the costs not work, but this year we're going to get those costs to where we need them to be and start rolling them out across the portfolio. I don't think, as far as our battery replacement strategy will change to lithium, just because we kind of have legacy UPSs that can't leverage that technology. So 70-degree air-cooled chillers, right? So we've been fighting this battle for years, right? Our PUE is too high. Our guy down the street's at 125, and we're at 14. And so we spent a bunch of time with all of our chiller manufacturers towards the end of last year, and we are going to have a 70-degree air-cooled chiller. So what does that mean? Today we have 60-degree air-cooled chillers. The warmest water, or the coldest warm water, the coldest water it can make is 60 degrees, right? So what does that mean? So if we're running 60-degree water and we put it to a cray unit, we pump it under the floor, really we're delivering 68-degree or 70-degree air to the front of those cabinets, right? You guys all push really hard in your contracts to get us to ASHRAE, and ASHRAE says we could run those things up to 82. Well, we literally have a system that can't get us there. Once we have a chiller that will make 70-degree water, we could start running up those temperatures at the front of the cabinet to 78, 80 degrees, and we get a huge efficiency savings on the back end. Now the beauty of this whole thing is it's not going to cost us any more money. Nobody has ever asked for a 70-degree chiller, so we posed the question, and these guys are all game for it. And we went to a factory tour, and it's like they're selling air-cooled chillers to all the cloud guys. That's what they're using. Nobody's using adiabatic. Nobody's using those type of things in markets that they don't have to. So this will be a game changer for us, right? This keeps our cost where we need it to be. It drops our PUE. We're going to be in the 1.2 range, 1.3 range across the portfolio, and it'll even give us the ability to retrofit some of our older sites where we have this PUE gap, where we could kind of focus our efforts in getting those chillers swapped out. So water is a big deal. The big part of this air-cooled chiller drive has always been that we don't use water, right? We don't use sewage, and a lot of these other cooling solutions, you need a ton of water to operate. And when I say water, I mean we're talking millions of gallons for a 4.5 megawatt site, and millions and millions of gallons of sewage. So it allows us to get to this, keep this air-cooled chiller, get the efficiency we want, still not, kind of have this zero water usage policy out there. And when our customers want to talk about green and carbon credits or solar power and all those things, we really need to focus and drive. Listen, yes, we're going to get green power, we're going to do all those things, but if you look at our site versus somebody else's site, we are not wasting water, right? And it's a huge resource for everybody. Q&A. Says I have 17 minutes, is that right? Okay. Oh, wait, no, hang on. Go ahead, Carter.
When you're talking about high density, the solutions that we've all talked about historically seem to work better with CPU. Is your team looking at GPU and how we cool GPU in the cabinet? And I know the chip manufacturers are still working to figure it out, but I'm wondering, are there crazy off-the-wall things that we've thought of on how to get to 35, 40, 50 kW in a rack when you can't take water to the chip the way that we have in Houston?
So, I mean, we haven't really, we typically don't look at the server technology unless the customer's really bringing it to us, right? So, but I mean, we spend a lot of time in this industry, especially on the construction side and the design side, talking about all these high fancy cooling. I mean, we just have to reject heat, right? And ultimately, water is 800% more efficient at rejecting heat than air, right? So if it means getting water to a chip or getting water to the end of the row, like we can do all of those things, right? But we're not driving the chip side of it on the server side. We're really driving to make sure that we have a solution that could marry up and support those things. And the nice thing is about a lot of the guys we work with in the industry is they're working for everybody, right? So they'll come to Laramie or me and say, listen, put this in now, right? Like make sure you have these taps, or make sure you have this flow, or make sure you have this temperature of water. So when a customer comes in, we can support these things because they're seeing it, right? Maybe not in our facilities, but for the customers that they're working for.
John, you said
A very exciting day yesterday. We'll fill you in on that over over the next hour or two. Give you a little color commentary on what went on. But if you were listening to the call, you saw some phenomenal results, and I want to quickly kind of go through those over the course of the next 15 minutes, then give you a little more insight in terms of why those results weren't as exciting to our investors as we had hoped they would be. But let me turn this over, and everything we're going to say you can't hold us to be accountable for, and I don't want to steal Schaefer's thunder, but I don't even want to talk about this either. This is kind of boring. But let's go through this. I'm way better at pictures than some of these numbers on there. But this year, how much did we lease? Who knows? The answer's on the screen. All right, little. One clue. It's on. Roman, how much? Roman? Yeah, let's go. How much do we lease? 153. Strategy does it again. 153 million. So that is like an incredible number if you think about it. And for those of you who are new, or probably 90% of you, were not around when we first kind of kicked this company off when we did our IPO. But at the time of our IPO, we were basically the size of that company. So if you take that 153 million, which doesn't include power, and you add the power to it that customers are going to eventually buy from us, you're roughly a $200 million company. That was the size of CyrusOne when we IPO'd a couple years ago. So it wasn't that long ago. And we just sold what the company was then. Not only did we just sell the company, what the size of the company was then, but the construction team built the company again, right? So if you think about, at the time of the IPO, we had been around for about a dozen or so years. We had been building and building and building and selling and selling and selling. And what we just did this year was basically recreate that company in 2012, which is just a phenomenal accomplishment. If you look at that 153 million, it is basically 1/5 the size of our company. So we leased $153 million, which is roughly 20% of our company, which is the fastest leasing velocity company in the entire industry. Typically, all of our peers grow how quickly in terms of leasing velocity? Not anywhere near that. Yeah. That is the exact correct answer. How anyone have any sense for how not near that number it is? Carvajal, what's your guess? I'm sorry, what were you saying? How much did we sell this year? We talked about it the last 10 minutes, Carvajal, but okay. Our competitors lease between 5 and 10% of their revenue, so significantly less than us. So this does two things. One is selling more is good because you grow faster. Selling more is good because you got to go build more. Where it's bad is then you got to finance it. And this is where we're going to get back to, or Di can explain later. She throws a wet blanket on all of this. But no, I just want to thank you all for what we did this year. This was just a phenomenal year. What we were able to do as a team is something that is just not really ever done. I mean, your average real estate company grows, Jamil, how much? 3 to 5%. How much are we growing this year? That was in that other slide that it was just a bunch of boring numbers. Anyone venture to guess? 20. There we go. We were with 22, 23, something like that, right? So really big number. So we were growing like 6-7 times faster than your traditional real estate company, which is basically kind of like dead man walking, doing nothing. You wake up today, you're going to be 3% better tomorrow, but you're really not doing anything. So what we're doing is really difficult to do, because to grow at this pace that we've been able to grow at for so many years is really kind of magnificent. And it kind of gets difficult to do when you're bigger, right? So if you're just, if you're going to double the size of the company in year one and you're going to grow at 100%, Colleen, how much would we be next year?
We would be 300 million.
No, if we were 1, next year would be 2. So we're only selling 1 more. So it's yeah. Her answer is, I just want you to buy more. I don't care. It's more. So it's harder to do. Like when you're an $800 million company and you're growing at 20%, you know, that's a really big accomplishment, right? So that is roughly the size of that company, you know, the 153 million, which is the size of this company. So it's really difficult to do as you scale the company, and it's even more difficult to do when you're a capital-intensive infrastructure company like us, because unlike a software company, you can easily double, triple, quadruple the size of your company overnight if they buy more, because once you have that software already coded and working, like there's really no more capital investment. People can just buy more and you can scale quickly. In our business, it doesn't work like that. Our growth is constrained by Hatem's ability to kind of deliver more capacity on the team. And oh, by the way, let me introduce Hatem on the team, who's on the podium here for the first time, to congratulate him. But it is a really difficult thing to do when you're a capital-intensive business, because you know you rely on all the capacity that we need to continually build out. So when you look on this screen here, these are just fantastic numbers all across the board, right? I mean, we blew out the quarter in bookings from an enterprise perspective. So this quarter we sold about $20 million of deals, which is a light quarter, but historically in the fourth quarter, which I never believed was any seasonality. This is the 3rd year in a row, so I'm assuming that our fourth quarter sales are slower. But we did $20 million in bookings in the fourth quarter. But in the fourth quarter, we did $16 million of bookings in enterprise. That is the biggest enterprise sales bookings quarter ever done. On that number alone, in enterprise deals, we sold more than all the other competitors combined, just on enterprise. Like, I'm not all the other, the smaller guys. So like a Switch and a QTS and a CoreSite, we just kind of blew it out of the water just for the enterprise space. What's great about the enterprise space is that they pay a lot more relative to the hyperscaler. So our average pricing in here was like $248. I don't know if we have this on a chart, but anyway, it was a big number. That was also a record for us as well in terms of the average price per deals. So if you sell a lot at a high price, it's always better than selling less and giving it away. Something I learned early on in business school. So it was a blowout year all across the board. If you look at how the portfolio has changed, that's what we were trying to get across on this slide, is to just highlight some of the other things that are not financially dependent, but are more operationally focused that we think are important. So if you think about like how many customers that we deal with that are investment grade that pay us, it's like 70, 75%, something like that, a really big number. That's really good because investment grade companies are likely to pay you back and make their rent. And you know, that's a good thing for you. You don't want to not get paid, right? So if you have investment grade customers, that's a really good thing. We have a high proportion of those. We also have 74% of our customers that are in more than one location, which is a phenomenal thing because, you know, as customers expand and they do more, if they are in multiple locations, that does two things. One, it's basically telling you that they like dealing with you, you know, so much so that they wanted to deal with you in other locations. And then the other thing it's saying is that if they did that and they made that commitment to go expand in multiple locations, that's also suggesting that it's going to be more difficult for them to get out. So if you do a good job, you're going to get more work, and this, you know, this party kind of keeps on continuing. And that's what you're seeing in these numbers here. The other thing that we did this quarter, which was phenomenal, was, and you know, shout out to Crespi and the whole team and Juan, is that tower was really, really magnificent. This isn't anything that's going to be moving the needle, but we built a really big tower on the Aurora campus, a 350-foot tower, and we put a bunch of antennas on there, and that's all for the fast trading environment because the CME is in our data center in Aurora. So the CME manages all of the futures trading basically that goes on in the country, and there's some stupidly big number, like $25 quadrillion of notional trading volume goes through there every day. And so if you look up quadrillion, there's like 22 zeros after the first number. So it's like stupidly big. But so everyone wants to go into that business. They want to basically be the first one through the door. So if you're if you're in that business, if you're second place, you're a loser. First place, you're a winner. First place is a billionaire. Second place is no one knows who you are. So it's a really big speed game in terms of how do I get into the business first? How do I get my trade there first? How do I basically arb the difference between what's going on in the spot market in New York and the futures market in Chicago? This is a really cool thing. We make phenomenal returns on this, and this is something that was unique for the CME because of the customers that we have and what's going on there. But this is also something that we're going to be looking to replicate around the country in our other data centers, because what's happening is there's an explosion of data. A lot of this stuff is going on the edge, and we think that there's going to be some type of opportunity to put more of these towers up in our facilities around the country. We make phenomenal returns on this, probably over 100% type return on these things. So it's really, really great. The other thing that we did this quarter was our interconnection business was put up the strongest quarter we've ever had. Bookings out the wazoo, really, really phenomenal. 17% growth rate is the fastest growing interconnection business in the country. So we're not really known as an interconnection business. We're really known as more of a hardcore enterprise data center business. And so having 17% growth in that business is phenomenal. And the EBITDA growth for that business is twice as fast. So Crespi and Bill and the entire team have just done a phenomenal job driving revenue, whacking expense, and kind of driving up the returns in that business. So really, really fantastic result. This chart was purposely put in the deck. What we were trying to highlight, to give you some color, was these are the yields that we make in Carrollton. So this was a data center that we built here about 5-6 years ago, just north of here. For those of you who have not been there, yeah, it used to be where we were all located when we didn't have windows. There's that number. You want to talk to that guy? Here we go. So this is where we were all located at. The reason we wanted to show this was because it relates to the bigger story that we're trying to get across to investors. Is if you look at this chart, what it shows is the amount of capital that we have invested in this facility over the years. So I think we bought that facility. It was an empty box for about $25 million. And what you see in that first column is, we were up to about $56 million. And the 4% in hooks above it basically is showing that we're losing money, right? So if you take your revenue, less expense, there was more expense than revenue, so you had a negative, you were losing money on that, and yet you spent $56 million. So typically companies who do that for extended periods of time find themselves out of business. So our goal is not to continue to replicate that. But what you also see here, which we've proven out, is that we put more money in, right? We put in another, I don't know what another $100 million or so, right? And then the next period of time, while we were losing 4% on the $56 million, we put in another $100 million, and we were making 13% on it. So now we got $150 million in there. We're clearing 13%, which is pretty good. We put in some more money, and we get 18%. We put in more money, we're getting 18%, really good. So we want to spend like $5 billion in there so we can get up to 20%. No, just kidding. But the point in this, now we got $350 million in here. We're making 18% return. These are unbelievably great returns. You do not get these type of returns in the industry at all, in any real estate asset. And the only reason we're able to do these returns is because we know basically how to design a facility. We know how to manage our costs. We can do things that no one else in the industry can. Customers are paying us, for the benefit of being in that facility. We provide a great service, and we make a decent amount of return on this. The reason this was important is because we have an outsized number of investments that we are making right now that are losing money, right? Because we're taking these investments with the goal, and this is Tesh, Matt, and Julian, and Chester. We're investing a huge amount of capital in these facilities that are going to pay off over time, right? And so while we're losing 4% in these facilities, we think, just like this chart shows, and if I showed you every other asset that we have we've developed over the years, you'll see the same type of progression. you lose money, and all of a sudden you start making money, and then you're like cranking out cash. So the intent of this, when we were sharing it with investors, was to say, hey guys, don't freak out. We kind of know what we're doing. You know, the reason that we sold $153 million is because we know how to do things that other people in the industry don't. The reason that we've been so successful over the last decade has been we figured out how to do things that other people don't. And we wanted to get them over any concerns that they had that we were investing too much capital to grow the business. Well, they didn't believe us, right? So that was the end result of this, and I'll come to more color on that. But that was the setup on this, because we were trying to show them that you want to do this. You want to put this capital to work, because these type of opportunities don't come often in life. You cannot generate typically an 18% return on capital that you're putting in. If everyone was able to put 18% return on a capital that you have in your bank, it wouldn't be long before you wouldn't have to work here, right? You could just live on all the wealth creation and making 18% compounded over time, right? So this is what we were trying to get across to our investors, to say, hey, you know, cut us some slack here, kind of go with us on this journey, on this ride, because, you know, the ride's been going really well for a really long time, and let us do what we do, and we're going to make you money at the end of this journey. So that was the intent of this slide. What we were showing on this slide was basically that explanation, saying, hey, if you see what we were able to do in Dallas in this Carrollton asset, these are all the other investments that we're looking at putting to work here, and follow us along in this journey. So what we are highlighting here in Santa Clara, we've been looking for property in Santa Clara, which is one of the largest data center markets in the US, and it's a market that we've not been in historically. We've looked for years and years trying to find properties that work for us, and you know, we've been unsuccessful because we've been pretty disciplined about what we're willing to pay for a particular property, that we can get some yield out of it. And we did a great job. In the third quarter, we closed on this, or fourth quarter, we closed on our first acquisition in Santa Clara. Great, it was a really cool facility. It wasn't really on the market. We kind of scooped in, we got it, and then we quickly followed up with an adjacent property right next door that we just closed on, I don't know, last couple weeks ago or something like that. Anyway, right now, between both of those properties, we have the largest data center campus in Santa Clara, which is one of those markets that we always wanted to get into, that we were never able to figure out a convenient way to get into it. This is the only market in the country that is really supply constrained, and that's good, because anytime there's supply constraints, there's less competitive pressure. That means pricing goes up, and this is the market that has demonstrated that over the years. So I'm really bullish about this. We're explaining that to the customer because we're going into 5 new markets. We mentioned that we picked up some additional land in San Antonio, and then the other thing that we are doing is Europe. So we're expanding into 4 new markets this year in Europe, 1 new market in California, so 5 new markets. So if you think about that other, you know, slide, that, you know, the 4% in hooks, you know, that was just one particular asset that we were losing money on. So what we're doing this year is saying, hey, we're going to go lose money on 5 new assets, and you know, and yeah, 5 new markets, and so that's kind of concerning to investors, and that's what you saw in that reaction in the stock price yesterday. So it was a pretty strong reaction because associated with purely our growth, because the guidance that we had given out was really kind of amazing. I mean, our top line growth was 19%. Our EBITDA growth was 16%. Those are the fastest growth rates in the industry, right? So typically you see like a violent reaction to share price when shit is hitting the fan, right? We saw that last night with Heinz. Heinz just like, holy God, what is going on there? What's happening there, and you saw that last year with GE and some other companies, is those are troubled companies, right? So you would expect a company that is really troubled to have a violent reaction. Like, you know, what's the most important sign for a troubled company? What happens? Who wants to throw in an answer? They cut their dividend. What's the other telltale sign when you're looking at a troubled company? What happens? They cut leadership, they cut staff. No, but what typically happens is they sell less, right? So if you have a product that people don't want, they buy less of it, and if your sales start declining, that is the telltale sign of a troubled company, right? So Sales cures a lot of ills, and when you don't sell stuff, that is a really bad situation. That is typically what happens in companies that are troubled, right? Is you have a product that's irrelevant, you can't deliver, and you are forced to pay the price, and that's what happens in troubled companies. And so when those things happen, like we saw in Heinz yesterday, tremendous amount of sell-off, people are really concerned. We've seen that in Snap, we've seen that in a bunch of different companies. What was really ironic in ours is that our growth is 19% and 16% at the profitability line. That is the strongest in the industry. So it's kind of weird in that here you have a company that is just phenomenally, you know, growing just really, really strong, the best in the industry, and yet people are like all freaked out on this. And the reason why is because of the 5 new markets that we're making capital investment decisions in, which is basically creating that decline just multiplied by 5. So that's the concern that investors raised yesterday. And what we were also highlighting here, and this is another drag on our earnings, but also strategically, like a phenomenal opportunity. What we were trying to highlight in GDS yesterday was, here's a company, while we're growing fast, they're growing way faster. They're growing over 100% a year. So we feel good about $150 million in sales. They're growing faster than that, right? So this is like a fantastic company doing really, really well. So our $100 million investment is, I don't know, $230 million or so. If you think about the value of that investment relative to our share price, it's worth $2, maybe a little over $2. So the point we were trying to get across to investors is like, hey, if you think our stock is cheap, it's even cheaper if you back out $2 associated with the value that we have in GDS. And oh, by the way, the GDS investment has been fantastic. They brought us to a bunch of different customers. We closed 20 megawatts in different hyperscalers this year. A great opportunity for us. It paid off really well from an investment, and from a broader commercial business sense, we're really doing well. I mean, they're bringing us business, we're helping them with business, and we follow that up at the end of last year with OData. So OData was this Brazilian entity that we bought into. We bought a 10% share for $12 million. So say it's roughly about a $100 million valuation for the company. What was interesting about OData is they just closed a $12 million quarter in bookings. So their fourth quarter, they closed $12 million, and that was a company that we had valued at $100 million. The other deal that was announced in the fourth quarter was a deal that Digital Realty did with Ascenti. Ascenti is a fantastic company in Brazil, and they acquired Ascenti for $2 billion. Ascenti sold $18 million in bookings in the quarter. And OData did 12. OData cost $100 million, and Ascenti cost $2 billion. So who made the better trade? And so we clearly did. But both of these results, both of these investments are just sitting on our balance sheet. We don't really get any benefit that flows through our P&L, so you're not going to see any revenue. You're not going to see any profitability. You're not going to see any of the love that you would expect to see when these companies are growing that way. But there's real value creation. It's just people are not able to recognize it because it's not coming through our financial statements. But these investments have been really, really great for us. So we've got those investments, and we've got a tremendous amount of work going on oh, sit down, Di. I'm gonna talk here for a little bit. Yeah. She's all excited to talk about the numbers, but so this is what's going on, right? So we've made these investments. We've made these we made these investments in China, in Brazil, and we are spending $400 million of capital in Europe currently going to build this out. Those are the right things to do. And our focus, and my focus from person kind of responsible for this party is to basically make sure that we're taking the appropriate steps to build a franchise that I think is going to be phenomenal. We are the only ones in the market that are really trying to build, and it's organically building, an international franchise, and we've been very successful in a very short amount of time. Those are difficult decisions to take, particularly given yesterday's violent reactions. And not only was, we were on the call having that, if like after that, Di, Schaefer, and I, and we meet with like tons of investors and analysts for probably 20 one-on-one meetings, every 15 or 20 minutes right after that over the course of the day. investor meetings at night. We just had an investor meeting right before the call, and we're trying to explain our rationale. And so they're really concerned about this, and they are basically held accountable, and you can kind of sense their angst in that they also are tied to the financial performance of the investments that they make. So they are paid to basically deliver returns when people give them their money. And so there's a lot of, tough feelings, really upset folks. So these are, difficult conversations to have. But our goal is to kind of explain why we think these are the appropriate things to do. And I believe in our strategy, and I believe what we're trying to do is unique. And we do all these investments for the purpose of recreating that chart that I just showed you on Carrollton, is that like all investments you do, you're going to lose some money up front and you're going to make some money in the future. And we do this because we think that the money in the future is going to be much, much better had we not done those. And we feel pretty confident about that because that's what we've been doing for a decade. And not only have we been doing it for a decade, but we are the best at this. So I feel really confident about our ability to kind of continue to execute and go do that. But it's difficult, and I do recognize when people give you money, like you do not want any of your partners to lose money. And so we do have an obligation to kind of make sure that we can turn that around to kind of drive that share price up. Then we have. We've been pretty kind of lax in the past on expense management. There are definitely things you all know of that, there's things that we can cut out that aren't going to impact the business that, we've been probably living a little large, on the lamb for a while. We're going to cut those back. So we're going to tighten down our expenses, and we're going to actively sell out all the capacity that we built this year. For those of you who were in the sales kickoff meeting, what I was pointing out was that at that point in time, we had about 500,000 square feet of capacity that we have invested in the business. We've invested that because we are anticipating those facilities are going to be sold. But as you see in that, that Carrollton slide, when you make these investments and you have it out there, you are losing money on that. You are losing money, and that's not good. And what we're trying to do, since we have 500,000 square feet in the U.S. that are sitting there, at the same time, we're looking at selling, we're making all these other investments in Europe. That is probably too much. So the focus is that we've got to basically tighten up on expenses. We're going to eliminate a lot of frivolous things. We're going to, for some of the things we've been jetting around, flying to different customer meetings, we're going to be way more thoughtful about that, kind of tighten up on expense. But the other thing that we're going to be doing is really driving the utilization out of all the existing assets that we have built in the U.S. because what we do know is for every dollar that you put in any of those facilities, 100% drops to the bottom line, right? So it's, if you get $1 of rent and you had an empty building, that's $1 that goes right to the bottom line. You get $2 go to the bottom line, all right. So that's what we're going to be focused on doing because we don't want any investors losing money, and we want to basically make sure that they know that we are not just frivolously going around not doing what we should be doing as stewards of their capital. So that's what we're going to be doing. So you'll be, if there's any focus or any questions coming out of it, that's the reason why. If you haven't been told about this, you will. We're trying to cut back and manage our expenses. We're going to be doing all the things to basically drive the business to get the sales going. The other thing I mentioned on a call yesterday was that we thought that the sales velocity had definitely slowed down in the last couple months. This was another big surprise on the call. And what we were trying to do was convey that we had a blowout year, but in the last couple months, it was a noticeable pause from customers in terms of there wasn't the same sense of urgency to close a deal as we had seen for the last probably 3 or 4 quarters. And so our guidance reflected a lower leasing velocity than we were anticipating. And I think that was the right thing to do in terms of the guidance that we were giving out. As we saw last year, these things can turn around very quickly, but we wanted to basically convey to investors is this is what we are seeing. Our plan for this year, though, is unchanged. We're going to be basically driving to $1 billion of revenue, and we're going to be focusing on expense management, all with the goal of trying to drive our per share profitability number up. Because what we had shared yesterday with investors was that our per share profitability number was declining. So it dropped, I don't know, a couple pennies from what we did in 18, and we're dropping that in 19.
And that's what freaked investors out. And we were trying to explain to investors, like, look, the reason why the drop occurred is because we're making all these investments on that Carrollton slide. Well, their response back is like, we don't want you to do all those investments. And I'm like, yeah, I hear what you guys want us to do, but you know, you guys aren't running the company. That's our job to run a company. And we're making the investment decisions over the longer term. You know, so our horizon is basically unlimited. And I believe that there's a real opportunity in the market right now to position this company to be the third leading global data center provider right now in the world, right? We're the third largest data center company now, you know, in the world, but we're not global, and we will be global. We've got a team in Europe that is really kind of pounding the pavement, going to be building out that franchise, and by the end of 2020, we are going to be the largest data center provider in Europe from a power perspective. Massive amount of capacity that we're bringing online. That's what our goal is, and that's what we're trying to do. The other thing, you know, that we're trying to do, which is challenging, is you know, kind of like you want it all. So if you ask my wife, she'll tell you, oh yeah, you want everything, right? And I'm like so the quest for growing hair and losing weight has been on my list for a really, really long time. I've struggled with both, like with forever. Or, you know, the challenge of wanting to be really successful and drive a great business, but also be like a great dad and hang out with your wife all the time. Those are all kind of conflicting things. The thing that we're doing here on a business perspective that is just as conflicting in that you can't do it all, but I'm not willing to give up either, is two things. One is just explain the strategy and the rationale. I think there's a huge opportunity. Secular demands in this space are like just outrageous. We're betting into that. We have proven competencies in doing something that's not been done. We can outsell everyone. Operationally, we execute like no one's business and have for a really long time. And so I want to take advantage of that and build this company up to something really special. The other thing that we have been focused on for a decade, and we just got like a little bit of love a couple months ago, was also being investment grade. And investment grade is the stamp of approval by Moody's and Standard & Poor's saying, hey, they're a good credit, they're going to pay you back, right? And so when you get that stamp of approval, that's really good because then you always get access to money. People will always lend you money. They'll always lend you money at low rates. So you could borrow money all the time and pay really low interest rates, and that's always a good thing for the company. Well, here's the conflicting things. We want investment grade, and that's basically associated with stability. You have to have a rock solid balance sheet. You can't get over levered. You don't want to have too much debt. You don't want to have credit card debt and mortgage debt and a second home debt and a boat, all those things, right? You don't want to have that, and you know, pursuing that and investment grade are kind of at odds. In our situation, what's happening is we are spending a lot of capital. We're going to spend over $1 billion of capital this year in pursuit of all these growth opportunities. And at the same time, we're pursuing investment grade. And so that means that if you want an investment grade rating, you can't over-lever your balance sheet, a rock-solid balance sheet. That then means that you are forced to go back to the capital markets and get your equity investors to give you more investment. And so if you just lost, you know, money for your investment, for your investors, they're less willing to give you more money, right? That's kind of pretty obvious thing. But the challenge, though, for us is both of those. So I want to do it all. I want to go grow the company. I want to go develop these facilities, build that international franchise, and I also want investment grade. And the challenge for us is we got investment grade with one of the agencies, S&P. We need it from one of the other two, Fitch or Moody's. And that's the tension that's happening right now because people are saying, okay, you're going to make all these investments, but you need another $500 million of equity. So you need me to invest $500 million more in your company for this, you know, dream that you have that you're going to deliver something special in 20. And there's no question in my mind that we're going to deliver all these results in 20. I think what we have in Europe going on is unique. I think we have a product there that is not really, you know, served up in that market, and we're going to win. And what I need from all of you is help on managing our expenses so we can cut and nip and tuck here and there. And then from the sales side, we need to drive all of these assets and get those things leased up so that we can drive our returns so that we can get that per share number up so it's positive. And that's what we're looking for. And that was the whole skinny and the conversation that we had, you know, yesterday on the earnings call. All the investor calls after that and the analyst calls, we're all around that same thing, so that they all fully understand what it is that we're doing and the rationale behind it. And so, so what you saw is like, you know, an 8% trade-off in the share price. You know, as a reaction to this, the market was down 2%, so about a 6% delta. But, you know, markets, you know, are short-term in nature. They go up and down for all sorts of reasons. You know, earlier, what we saw a couple months ago or a couple weeks ago was that we traded down below that. I think we broke $50, so we were below that for no new reason. So the market is pretty fickle. The other thing is the market is way more short-term focused than we are. If you look at the average amount of volume in our shares, most investors just rent the stock for, you know, 3 months and then they're out of it. So they're not really long-term investors, and we are all long-term, you know, investors in this company, because we're building you know, a franchise here that's going to be running for a really long time. So that was my pitch today. So I wanted to thank everyone for the results this year. This was really fantastic year, and I'm looking forward to doing it the next 5 years. Now, Di, I will hand it over to Di.
Thank you. So it has been a humbling couple days, and Gary touched on that, and I'll get into a few numbers. He's really covered the numbers, but only to top off a humbling couple days, my boss tells me to sit down. It's a beautiful thing. So, okay, so earnings day was yesterday. We released earnings on Wednesday night, and that's when the flurry of calls and emails started to come into Schaefer and me. So earnings is always interesting. I call it game day. So you're really, all your adrenaline's going, you're prepping, you're ready for it. But Gary always has some surprise, some outfit he wears, some, I don't know, something. So yesterday's surprise was this. So we sit down in the conference room ready to, it's like a minute before we're going live, and he's like, Di, lean back, put your hands on the wheel. He said, we're about to take off. So look at Gary. Oh, and then he puts his aviators on. So he's obviously the pilot, I'm the co-pilot. He's got his hands firm on the wheel. He is looking out the windshield. Notice my eyes. I am looking at heaven and saying, please, God, let us get through this and come out alive. So that was the start. Okay. So again, 2018 was a phenomenal year, and we don't mean to overshadow just because yesterday was a tough day on our stock. You know, 2018, we blew everything out of the water. Revenue, EBITDA, FFO in terms of dollars. Our per share growth was muted last year. I think it was, in the end, 6% for the total year, or 2% for the quarter, but really great year, and Gary covered all that. When you announce year-end earnings, you also announce the quarter. So again, really consistent, you know, growth across revenue, EBITDA, FFO, but then the per share was 2%. So we were kind of showing, because of all the capital we're funding, that it was having some pressure on the per share. Market diversification is great, and this pie is only going to get better. So when the company went public, it was really Cincinnati, Houston, Dallas. Now look at that. We're in all the major markets, you know, and adding Santa Clara and adding 4 European markets. So, and look, investors over the long term love diversification of your geographies, diversification of your customers, because it just makes you a safer company. So this is all good news. And then our portfolio, our occupancy was, it's hard to read, in the stabilized properties is 92%, which is phenomenal. So with all that growth in the actual footprint of the platform, we were still in our stabilized portfolio 92%, which is a great number. You see the 88% overall, but that's because you have non-stabilized, which is just assets that are just coming on. So they stay in that bucket for like 18 months unless they come on over 90% leased. And here's the development pipeline. So, you know, Hatem and Laramie and team, these guys just crank it out year after year. Last year was, again, another record for construction. But this is just what we're sitting on in the development pipeline right now, almost 450,000 square feet and 126 megawatts of capacity. And that's where the numbers come in. The estimated to complete is between 600 and 700 million, plus you layer on that all the new development that we're going to do this year to meet the demand, and particularly with the big push in the European markets. But again, we really do have a fortress balance sheet. You know, on a total enterprise value, we're like 70% equity and 30% debt. So we're very lowly levered, and as Gary already covered, we're doing that to get to investment grade. We're 50% of the way there. Once we get to investment grade, it's going to be a great thing. Our cost of debt will be lower. The market's always open for the investment grade market if we have to issue debt. And the REITs that have investment grade ratings tend to have higher multiples, which leads to higher stock prices. So again, this is a capital intensive business. It's a long-term business. We're going to be in it, you know, for years or decades. So it would be silly in the short term to abandon the strategy to, yeah, whatever that word was, the push to go to investment grade. But that is that competing force with having to issue more equity to maintain our net debt to EBITDA in the mid-5s range. Lease commencements, again, the great leasing year led to, we're sitting on about 55 million of backlog, which again is a great thing because that means 55 million of our revenue increase is already in the bag, and we know we'll achieve that in 19, and everything else above that is how we get to $1 billion in revenue. So this is the bottom line, the guidance chart. So we gave guidance on all these statistics, which we do every year at this time. I think revenue growth roughly 18%, 19% adjusted EBITDA, similar, but it was the per share. So when you focus on the per share, and our 2018 results we revised for pro forma for the new lease standard, which wasn't in place last year, is in place effective January 1 this year. So we are, throughout the year, going to adjust last year's actual pro forma for this lease standard, so it's an apples-to-apples comparison. But bottom line, we ended last year when adjusting for the lease standard at $3.22 per FFO share, and we gave guidance of $3.10 to $3.20, so below where we ended last year. And, you know, everybody goes to the midpoint as what they think you're going to do, and so that's about a 2% decline, which doesn't sound like a lot, but Gary already covered it. The investors weren't happy with that, and they were surprised by it. So, you know, initial reaction, not very positive, but as we go through the year and as we report bookings, which I'm sure will be great numbers as the year progresses, if we walk guidance up because we're actually going to beat this, if we get to the $1 billion and hit the high end of the guidance, you know, over the course of the year, our share price should certainly recover. I have a few call-outs. Oh, I'm not going to do non-GAAP reconciliations. Oh, wait, where's my call-outs? Selena? Oh, sorry. I had some call-outs, but I guess I'll do them next time. Sorry about that.
You want to call now?
You can still say it.
Yeah, let me. Yeah, sorry. I don't know where they went. Yeah, geez, I need it. It's been a bad week, so my head's kind of in a fog. But I know some of the call-outs were for sure. I wanted to call out the IR team. Michael Schaefer, Tom Berry, Doyen. It has been crazy since the first of the year between, basically they're the depository that does all of Gary's decks, my decks, so between sales kickoff, you know, the board meetings, now all the investor materials for the earnings. It's been insane. I think Tom Berry basically lives in his office, as does Schaefer. But these guys really, really work hard, and I wanted to recognize them. The other is Mike Schwartz and the whole FP&A team. That's another team that works all the time. They are constantly running revisions to the numbers. You know, we formally reforecast monthly. With Gary, we reforecast weekly. But so, and as you know, that whole team supports all of the functional areas to provide you the numbers, you know, how you stay on your budgets and how you meet the forecast for the year. So that team just cranks nonstop as well. So I want to recognize them. I wanted to recognize Stephanie Ellis, who did a great job working with the UK accounting team at the end of the year. She flew over there, she trained them, she made sure that we got our numbers right, because that was really the first full quarter of consolidating them, plus it had to be in the 10K, so it was a lot of work. And Stephanie was our point person in accounting, so thank you, Stephanie. And then Dominic. Dominic is another one that just cranks constantly. And it was particularly harder. He's our director of SEC reporting, so all our 10K, 10Qs, proxies, working with legal and accounting and everyone else. And he's always had to work a ton. But this year, at the beginning of the year, Ada, his number 2, resigned to go work for a company that was closer to her home. It was a lifestyle and family life balance choice. So Dominic did this whole 10K season solo, which is unbelievable. So, and he's always steady. I think he's in the office doing the 10K now. But the guy is unbelievably he's unflappable, so we want to recognize him. And my last 2 were welcome back to the party, so we have 2 boomerangs in accounting. They left, they thought the grass was greener, then they really missed Wojo. Well, we'll question that judgment, but no, they boomeranged back. So Lisa and Shrini have rejoined us in accounting. I was like,
Can I stand now? Thank you. So you guys, listen, you heard Gary and Diane talk about our results, and I'm always fortunate enough to get to go after them because I get to say, hey, listen, our results were so great, and then I get to talk about our people. And our people are so great as well, and I feel like I have the best topic, no offense to anyone up here, but I feel like I have the best topic to get to talk about because without our people, we don't actually have a company, right? And so when Gary talked about, you guys, we're going to beat this guidance this year. We are going to beat the guidance this year. Those of you who are on the phone, and those of you who are in Europe, and those of you who are everywhere else, sitting in the office probably working, and then those of you in this room, I look around and think, we're definitely going to beat the guidance this year. We're going to do this. This is the team to do this. So I don't know about you guys, but I'm really excited about this. Are you? Yeah. We got this, right? We got this. And here's where I'm also excited, 111%, 111.7 on our bonus. Who's excited about that? So we turn around and we beat this again this year. We're going to have a much bigger number up here next year. Who wants more money? Anyone? Anyone? Thank you, Nicole. Anybody? Right. So our bonus pay date is March 1st, so everyone will be out celebrating that day. Come right back to work, please. Nobody gets to leave after that. Two things before I forget. I always forget, like, the announcements right before I come up here. People say, don't forget to say this, don't forget to say that. And I'm like, I don't even remember where I lived, much less what to say. But 2 things. Andrea Munoz, congratulations to her. She just became a grandmother for the 2nd time this morning. Yeah. Caroline's in the world. Yeah. Kim Doan became a grandmother not too long ago when Grace went into the world. And please, if there's a God in heaven, I will look as young as they do when I become a grandmother one day. So congratulations to you guys. Kim, I know you're surprised. I know you want me to put a picture of Graceland up here, and I'll do that next time, okay?
It'll be all over the newsletter.
In the newsletter, got it.
Every month.
Just really quick, you guys, I want to give you an update on our office move. So we began construction on the interior of our office. For those of you who may not know, we're moving to a Harwood 10. It's really across the street from our current office. And we're going to have the top 3 floors. We're really excited about it. It's going to be a state-of-the-art, really beautiful office. We will begin early. It began early in March, so our construction expected to be completed by the end of June. And so our move will be in July. You're going to have a lot more information about this, but I want to just keep giving you updates on what's going on. It's going to be a really quick move. It's across the street, right? So you're going to pick up your stuff, you're going to go to your new cubes, and it's all going to be great, right? Everything's going to work. It's going to be exactly fine. So I'll let you know more about that, but I wanted to just keep giving you an update. We're going to pull together some teams here in the corporate office so that you guys can help us figure out how to lay things out, where you want things. So it's going to be really fantastic. So we're excited about that. The other thing is we won an award. So Fortune's 100 Best Places to Work for Diversity. And I know it seems like most of the people who work here have no hair and are bald white guys, and I know they're really, really nice people, but we don't all look that way, right? We don't sound that way. We don't think that way. And as I look around this room and I think about our other offices, the people who are on the phone and on the video, I'm so thankful, right? Because we are a really diverse organization, and we rightfully so won this award. So congratulations to us. We're going to keep driving here, but I'm very, very excited about this for sure. So company update really quickly. So one of the things you guys are going to see on your paycheck is we set up a new structure for our parent company at CyrusOne. No change to you other than the fact that you're going to see a new name on your paycheck. It's called CyrusOne Management Services. I want to just put that out there because when you get a new name on your paycheck, people are like, wait, what happened? What'd you do? What happened? It's a new parent structure. It will happen. It happened on February 10th, but you'll see it on your next paycheck. So I just wanted to get that out there really quickly. All right, so remember you guys last year, Austin, Jeff, Leslie, Steve, the HR team went on this HR Roadshow and had a conversation with you about what to start, stop, and continue. Well, we finished that and we've gotten the results, and I want to talk to you for a moment about a few things that you said to us. I want you to know that we did listen to what you said. I know we laughed about it last time about all the things we weren't going to do. But listen, you did tell us to start, stop, and continue. So it wasn't just these specific people on the screen, although we picked out clearly the most beautiful people in the company to put on the screen. But let me tell you what you said to us. So you said the corporate office has all the fun. The remote offices actually don't do some of that stuff, right? It's been a lot of fun this week for sure. Hasn't it? The grass is always greener for sure. So one of the things we've done is we created a process for remote sites. So each of the remote sites has a site leader. And so you guys out there, you can do things yourselves at your own site. You don't have to wait for corporate to tell you to do this, okay? And so you'll essentially be in charge of your own fun at your own sites, right? So throw your own parties. So the names at the top of each of these, what are those, stop signs? I don't know. The names at the top of each of them are your site leaders. So they're kind of your voice there. They're the ones who are leading your site there. So if you want to do something fun, you guys want to volunteer in the community, those kind of things, you talk to these people. So Dorian and Chris and Randy and Greg and Gabe, you can see that they're all, I'm sure they're all thrilled. I'm sure they were all voluntold to do this. And so let me thank them in advance for being our site leaders, but thank you for that. And you guys can go figure out now how to have fun at your locations. What we heard, I want to better understand our total rewards package. What we're doing about it. In 2019, we're going to take a really in-depth look at you guys hear me all the time talk about, you have to get a physical, you need to be healthier, those kind of things, right? So now we're going to focus on financial welfare as well. So health and financial together. We're going to have a series of seminars. We haven't decided yet what the format is, but the series of seminars is going to walk you through a lot of your own financial opportunities. What is 401k? What is this ESPP thing? How much should I be saving for my future? What's my retirement look like? And we're going to bring in some of our own vendors that are going to help you think through your own financial options to make sure that you're maximizing your own wealth. And so some of these topics, 401k review, retirement planning, employee stock purchase plan, benefits, education, wellness plan overview. So this is your chance to sit down with the professionals that we have an access to talk about your own financial planning. So I'm really excited about this because you'll get a chance to talk one-on-one. We'll have a group session, and then you'll get a chance to talk one-on-one to the professionals in this area. So that's coming up in 2019. Let's see, what else did you say? I want more flexibility in my paid time off. We hear this a lot. Can we go into can we bank our PTO for the next year? And what's Gary's answer to that? Thank you. You got that. Finally, nobody asked that for the questions this time, so I'm really excited about that. But let me help you understand your options on this. So remember, for your vacation time, you guys, you can go 40 hours in arrears. And I don't know if you guys really realize that, because what happens is you accrue your vacation time starting January 1st. And I hear employees say, well, I can't go on vacation with my family in February because I don't have enough vacation time accrued. Well, the answer to that is you can actually go into arrears by 40 hours. You just have to catch it up throughout the year, right? So that's the flexibility on your PTO. Remember, you get 9 company holidays, 2 floating holidays, 1 volunteer day. This year it's three days in between Christmas and New Year's. So I don't think anyone's saying you don't have enough time off. I think what you're saying is, how do you go figure out how to work that around your own family planning and schedule? So that's how you do it, all right? What are we going to stop doing? So what we heard from you is we're tired of the J.J. Keller training videos. We've kind of beat this dead horse, right? J.J. Keller's out the door. We booted them for sure. So we're getting a new learning management system with new compliance training vendors. So unfortunately for you, compliance training is still coming back. It's just not going to be in the J.J. Keller format. It is Cornerstone. It really is a state-of-the-art compliance training system. I don't know if you guys are familiar with Cornerstone, but it's very much more user-friendly, very much interactive. You're not going to see the same videos that you saw for the last 4 or 5 years on. I know. So Gary, when you can't open 10 windows at once and do your compliance training, you can thank our employees for that. So state of the art, that's right.
No cheating.
That's right. Look at our ELT, no cheating. So we're really excited about it. It's coming up this year, so you guys will see that roll out. What did we hear from you? Multiple badging systems to make my job more difficult. The security team has a major project to update several sites' badging system in 2019. I probably should let Mark talk about this, but Mark's really in charge, so that's why I put his picture on the slide. But it should be where you can either, Mark, help me here, you can either thumbprint or use your print.
So what will happen is, instead of having to redo your biometric at every single location, you have to go to a site and pre-register. It will be one system all the way across every single site.
So he said once, for those of you that couldn't hear him, one system across our portfolio. That way you don't have to do your biometrics at every single site when you show up, for those of you who travel to every single site. So that should make your jobs much more easier for sure. And then what are we going to continue doing? What we heard from you, the week off during the end of the year, the 401k match, the bonus, the cultural events, the recognition, the volunteering, the employee stock purchase plan, and remember ESPP at 15%, so don't miss out on that. If you miss out on that, you're giving away free money. Do it, please. What are we doing about it? We're going to continue to be one of the best companies to work for. Again, Diane mentioned it, but Lisa and Srini were really happy that you guys came back. And we talk about the grass isn't greener on the other side. Listen, I'm not even worried about the grass on the other side. I'm worried about this party here on our side, right? We're having a great time. And it's a fantastic place to work. We're going to continue to do that. We have a whole lot to be proud of. And again, we're going to beat that guidance this year, right? You with me? Yeah. Yes, thank you.
So I'm not going to stand up.
How are they going to see you?
Yeah, well, I wouldn't be much taller if I was standing up, Kel. So ultimately, this is a kind of a big shout out to my team and the stuff that's been going on. But to preface that is what my teams do could not be done without everybody in the room and everybody on the phone. So I just want to run through this real quick. You know, Danny, who's probably been here longer than most of us, continues development across Texas. Numerous projects going on, Carlton, Austin, Houston, and San Antonio. Craig Deering and Andrew Ford, who just started with us. We have, I don't know, we did the last build was 140 megawatts built in that market in Northern Virginia. So those guys are killing it, and they have a team of guys that are supporting them. But really, you know, those guys are the ones who drive the ship there, which is amazing. The Aurora office and the tower, which Gary showed up there earlier, Juan finished all that work, and sales is going to start selling some stuff in Chicago, so Juan could get back to work in Chicago. But in the meantime, he's banging it out in Jersey and North Carolina right now, supporting those builds. Hector and Kayla in Phoenix, the dynamic duo down there, We're finishing up another building down there, which is the first cloud center that we're deploying in Phoenix. And that's going to be the 7th building on that campus, even though it's named Building 10.
They're good at building.
So Jeff Devine is a month away from his permanent relocation back to California to work on the Santa Clara project, which we showed up here earlier. Jeff has traveled around this country for CyrusOne. So huge hands off to him. He worked in San Antonio, he worked in Virginia, he worked in Chicago, he worked in Dallas, and has constantly picked up, moved, did work, and moved out. California is home for him, so hopefully we get him to stay out there. There's plenty of work to do in Santa Clara now. And he also got a promotion on making that move. Keith Cronshaw, new to the team, obviously, supporting Tesh, and I'm sure he's going to talk about that. But we're kind of getting him integrated into what we do, how we do it, go fast, don't spend a lot of money, right? And the project coordination team, Nathaniel, Joy, Robin, the amount of, we talk about $1 billion in capital. Is that what we did last year, Di? 900. So, you know, 700 million of that is pushing pretty much through construction. And that team just processes all the POs, you know, with the procurement team and keeps my guys, you know, the construction team stocked up with equipment and everything we need to get done. So hands off to them. Laramie obviously is the guy who gets his name up there a lot, and Gary talks about it, but these are the guys in the field to get it done. Really do it. So the operations team had a really tough quarter, I'd say, of work that had to get done. And we did the transition to CBRE up in the Midwest, and I know we have a question about that we'll touch on. We completed the rollout of a new computerized maintenance management system, which for everybody in here probably sounds really boring. But this is really for us to automate maintenance, right? And start to do some actual AI stuff on the maintenance side of our business, which is really to help us cut those expenses. This is what we do. A big portion of our expense is what goes on in operations. 6,378 preventative maintenance work hours during 2018, right? And during Q4 of 2018, which, to put this in perspective, we're managing close to 700 megawatts of capacity. And that's the end number. So that's not what we lease, but there's 700 megawatts of generators and UPSs and Cray units and chillers that's getting managed by this team. So the numbers are phenomenal. They've grown, you know, unbelievably. 3,522 whips got installed in 3 months, so it's about 1,000 a month. That's how our customers hook into our power, and that's what we sell at the end of the day. So in Chandler, for anybody who was out there or for the folks who are on the phone, we more or less did open heart surgery in the middle of the Chandler campus. We disconnected the utility every day for about 2 weeks, ran on generators the entire site, pissed off the neighbors. But we did more or less open heart surgery on this campus. Not a single issue, no downtime, no complaints except for the neighbors. And phenomenal job to that team out there, for Ed, Hector, who led that, and to Phil for leading that. So Northern Virginia, with all the construction going on out there, obviously tons of work on the ops side as well. And then the commissioning team, which probably the unsung heroes of what happens every day, those guys are really the guys who sit between construction and operations to make sure that we get a good turnover. You see the numbers up there. Every megawatt that we talk about building has to get commissioned, has to get tested. That team flies around the country and does that for us, led by Andy, and for all those folks who know Andy Kachansky and his team. All right. So engineering team, I'm kind of going long here, huh?
Dude, you're killing me.
Killing you? All right. So engineering team, another bunch of unsung heroes, but Wayne, Elliott, Cole, Mike, and Barron really just take care of the portfolio after construction walks away, right? So all the stuff that needs to get done at these sites after we finish them and after they're making an 18% return, there's still work that has to go on. We have to do upgrades. We do things for efficiency. These guys are rock stars at that. They literally walk around the portfolio. Those are the guys picking up dollar bills off the floor, right? I mean, we are doing improvements to these sites that's saving, you know, millions of dollars in operations. Driving down PUEs, you know, making our existing customers happy. and keeping the construction team focused on new development. So hats off to the, hands off to the, or hats off to those guys.
Hands off too.
Hands off too. And then the solutions engineering team, there's no highlights, right? They just help sales, right? Those are the guys that really just support the sales team. For people who aren't in sales, they typically don't see these folks, but just like the commissioning team bridges that gap, these are the guys that bridge the gap between our sales folks and technical conversations. No offense to the salespeople. And last but not least, if it wasn't for Cheryl, none of this would get done. So everybody in Dallas knows who she is. So thank you, Cheryl, and we appreciate it.
Thanks, man. Great. Is it me? Are we going to the video with Tesh? Or? It's me. Excellent. All right. So ouch, quit it. Okay. Look, I'll be really brief here. I actually only have one slide and then some Wolfpack nominations. But before I even get into what the next slide is, you know, a bunch of people have come by my office to talk to me about sort of what's been going on and, you know, yesterday's stock movement, some of the things that we've been doing from an investment perspective. And I just want to say, you know, to folks on the phone and everybody in the room, we have made all the right decisions. In China, investment, no data, buying Xenium, organic development around it. Every decision is the right decision for creating long-term value. And you should have a tremendous amount of confidence in that. We are playing a different game than our peers. They're playing checkers, we're playing chess. And when the smoke clears, we're going to be way ahead of everybody else. All right, so what are our priorities for this year? Look, keep it really simple. We're very focused on getting the operating leverage out of the investment that we've put into Europe. With Tesh leading the team there, I personally couldn't be any more excited. I've called Tesh the GOAT for a long time. He really is the greatest, and we're very lucky that he has leaned in to go over there and already help develop what is a great team of people. We're going to use every tool in the toolkit. That is, we're going to do JVs, we're going to do organic development, we're going to do land option agreements. The goal here is to give our customers the opportunity to work with us everywhere, but also access customers from everywhere at the same time, all really while doing it with the least amount of capital. The second is we're going to do creative global land ventures, again, working really closely with Kevin and the project development team. We're going to find partners in every market, including the United States, that will allow us to deliver unique solutions to our customers. And I'm talking about looking out and saying, what is the market going to demand from us 3, 5, 7 years from now? Our biggest customers are going to be looking for 100, 200, 300 megawatt campuses. That's a lot. There's a lot of cost, huge investment. And these are big decisions. It'll take a long time to make, but we're working with partners already, and we're excited to be able to tell you about those once we get them all done to provide those long-term solutions. So stuff that nobody else has done in the market, we're going to be doing those things. And the last is, this is a year, and you've heard Diane beat this drum, we're getting in line behind her. We're going to be thoughtful stewards of capital, so we're going to use creative structures. We're going to be more thoughtful than we've been in the past, given the constraints that we have. The ability to drive forward while doing it under a microscope with less capital, you're going to see us do things that few people have been willing to try to do. So net, finish Europe, find ways to deliver very large capacities, not only in Europe but across the globe, and all while being very mindful of the capital. So Wolfpack nominations, we got 9 this quarter, so the group continues to grow. As always, there are no repeats, so once you're in forever. First to Jim Lancaster, thank you for the site tour up in Carrollton, incredibly informative. We talked a little bit earlier about what it meant if, boom, crushed it. Woo. Yeah. But you know, Gary talked about what happens when, you know, companies go bad and the stock price goes down and sales, things like that. But another thing that and I think Kelly alluded to this, but another thing that happens is people leave. And that is always a scary proposition. When Jim gave us a tour, the thing that I liked best about the tour was not only how much he knows about the data center, but how passionately engaged he was. It was his data center and the pride that he had. And that's something that resonates, I think, where we go around every time we visit a data center or we get to see people, and even in the corporate office. But Jim had great pride. Thank you, Jim. Calvin Harris, you guys know him as Greg Higgins. We're going to do it, you know, my way. Listen, Calvin is a great guy. But look, you know, Greg leaned in. He organized the marathon teams for this year, Dallas Marathon. We had 3 teams this year. A couple other extra individuals ran as well. But, you know, it takes a lot of time to get everybody organized. And I think that everybody who participated had a great time. Greg did a great job. He's a source of positive energy, but also building communities inside of our organization. Greg, thanks so much. Mindy, she was one of our athletes, if you will, on the marathon team. But honestly, I just have so much respect for Mindy. She's kick-ass, and I always hear from Diane and Mike Miller and everybody who works with her how great a job she does at her primary job. But I got to tell you, folks, she is one dangerous lady. If you work out, she will crush you, because she is often in and out of the gym by the time I get there in the morning. This morning I walked in, and I can always tell when Mindy's in the gym because the rock music is blasting at top volume. But she was doing some sort of Karate Kid style exercise, like balancing on one foot and air kicking. She's dangerous. We need her. Welcome to the Wolf Pack. Absolutely. Ashley Panfil, listen, we're really excited to have Ashley as part of the team. You know, my first interaction with Ashley was probably in the first or second week of joining CyrusOne. I was on a panel at DCD, and after the panel, Ashley sent out this really positive and incredibly embarrassing email about me. But I never really got to know her until I hosted the holiday lunch up in Carrollton. And she did 2 things which really blew me away. The first was she included me in her business and made me a partner on a revenue project that she wanted to work on, which made me really excited. I felt included. She had heard what I had been saying, and she wanted to deliver that, and she engaged me in that conversation. The second thing she did was she was interested in my family, and we had just moved down to Dallas. We're almost 2 years down here, but she gave me so many great ideas for my kids, for my wife, for all of us to do together, and I was grateful for that, to engage me on a personal and professional level. Thank you, Ashley. Fred-tastic. He does get the award for the scariest photo I've ever seen. It's so weird. It's mesmerizing. If you stare at it too long, you will be hypnotized. Oh. Anyway, listen, Fred, I just love the way you do business. I'm glad to be on a team with you, Fred Holloway. Raven Patrick. Raven doesn't have a photo, so I just put up the Raven from Edgar Allan Poe. Will she have a photo? Nevermore. Listen, Raven's super cool. She was part of our marathon team also, but she's also a tremendous asset. In fact, we have a great IT support staff. Hopefully we'll get to recognize the whole team over time, but we wanted to reach out and support Raven this time around. Welcome to the Wolf Pack. Matt Pullen, look, another great add to our talent in terms of the European team. Matt is multi-talented, and he really adds value in so many different places. Obviously, he's the head of sales for Europe, but he works with site acquisition, strategy on the M&A side. He's so plugged in across Europe. He's a great source of data for us in terms of how we think about the competitive landscape. Matt, thanks so much. Coop. So listen, I met Coop about a quarter ago. It was my real sort of first exposure to him. And when I first got to know him, I thought, what a giant pain in the ass. and I've got to know him much, much better. And now I think, you know, what a giant pain in the ass. But I got to tell you something. This guy gets it done, and he's got his own style. He's a maverick. I was really impressed when he got me involved. Yeah, he wants to do it his way, and he needs to get it done because he's got a super high level of perfectionism. But he is a tremendous partner. He's all heart. He cares about this company, and he's really successful. Coop, welcome to the Wolfpack. Look, final person here, Wolfpack. Look, I have said, if you hear, there are a couple of things I say probably too often, but I have said, you know, life is about the journey. It's not just about the destination. And a lot of journeys are long journeys, but you can't go on a long journey without taking the first step. And this next person, he's been a good friend of mine pretty much since I joined, but he's on a journey, and I see him in the gym making efforts, improvements all the time. Tremendously positive human being. It's Michael Coleman. He doesn't have a picture, but this is another great Mike that I just put up there. But Michael Coleman, first of all, get your picture in the system. Second of all, we want you on the Wolfpack. Thanks for everything, and good luck on your journey. Thank you.
Can't possibly be next. Are we not going to Europe? Yeah, we're going to Europe. I don't go. I'm last.
Good morning, everyone. Welcome to the European update for the all hands call. You know, when I left the U.S. for Europe, there were a couple of sad faces. No two faces more sad than Maria and Selena. And so I just wanted to let them know that I'm okay, and I wanted to give them a little keepsake for their desk. So to Maria and Selena, here's a little picture of me for you. This is the team in Europe. We've added 7 new members. They're highlighted in green. This is the team about 44 now, and we're probably going to about 50-51. This is the team that we're going to battle with. We are prepared to launch an assault on all of our competitors in Europe. This is the most collaborative group of folks that I've ever met. Please call them for any deals that you have. Ladies and gentlemen, we are open for business. Europe has 8 megawatts of available power and over 4,000 square meters across the 2 markets, London and Frankfurt. Please start selling. What we show on this chart is that all of the capacity will be available between Q2 and Q3 of 2019. So sell, sell, sell. We would like to really thank the project development team and the strategy team. We are now in position to take over Europe. Their efforts have placed us in the prime locations, in the prime cities to be effective. Thank you, Lindsay and Jonathan. What this chart shows is that after we've completed our land and shell capacity on what we have available today, we will be able to add 175 megawatts and over 100,000 square meters to our portfolio over the next 2 years. We have committed close to $300 million to get this done. We are open for business. With just building what we have, we will be the 3rd largest provider and have the 3rd largest platform in the EU. So I encourage you all, go sell. We're off to a great start in Q1. I want to thank Matt Poulin, Julian King, and an assist from Jeff Harrison. Year to date, we're able to get 3 megawatts out of Oracle and 3.5 megawatts out of AWS, both of these in Frankfurt. And in addition, when Amazon signed the 3.5, they also added 11 megawatts of reservation in Frankfurt 3. I want to thank everyone from, on behalf of the entire team here in Europe. I want to thank everyone in the States for all your support. We're off to a great start, and let's keep it rolling. Have a great day, guys.
Okay. We have a board call in 35 minutes, so I'll be. I wanted to do some shout outs to the new team. Isn't that nice? Oh, yeah. Isn't that nice? Yeah, the problem, I did this chart originally all in blue, and I sent it to Bill Sullivan, one of our directors, and he sent me a note back and said, Robert, your legal team's getting huge. The legal budget must be going down. And I had to redo the colors because it's not all lawyers. It's not going down. Let's see, the new team members, Ashley, Tammy, Stephanie, Gerald moved from HR to legal, and then Jamil has joined as the simple dead man walking real, which I'm pretty excited about, but so welcome to all of them. This was a slide I put up at Sales Kickoff. I just wanted to remind everybody to be careful out there. The ethics and compliance that Kelly mentioned. And I'm really excited about the environment and working on together. And that was it. The note was a little messy today. It was, the theme of yesterday and today, it was a tough day for Gary and Diane. I'm a simple real estate guy. I'm a simple FFO guy. I once put a plan together with a team to deploy $1 billion over 5 years, and we're going to do it in a year. And so I'm really excited about 2019. I love coming to work every day. I love playing the game. But the execution risk we have this year is huge. It's a really important year, and we have to do it better, faster, and cheaper. But $1 billion is a lot of money, and so it's a great year to be here. So everybody should enjoy the year. As far as my suggestions for the team, John, I would get Barry to do your slides. Yeah. Tesh on tape was interesting. A script is a nice, like if I could give everybody a script, that would be okay. They could read it. I finally figured out the wolf pack. Schildkraut just wants more head count. And so, it took a while for me to figure it out. I think that's it. It's going to be a great. Criticize my slides. They were just hard to read. They were.
So each quarter we have this meeting. There is a separate questionnaire or something that Dylan sends out, basically giving you the opportunity to put in any questions that you want. We did it anonymously because in the past we found that we put it out to the group because no one will ask the question of being perceived an idiot or the dumb question or whatever. But anyway, so there's anonymous survey that's put out. Please put your questions in there. If you have any concerns, or you can always hit us up directly. Here we go. Clarity around performance. Team, I guess. Look, I mean, everyone is judged, relative to your peers, opportunity. So this is, how is it used? I mean, if you have a higher ranking and you're showing your commitment to the company, you're going to get more promotions and bigger opportunities. So So that's how you kind of manage your career. Will CBRE employees ever become CyrusOne employees again? So sure, you know, as we need more people and there's opportunities that open up in our company, they are welcome to apply and join our CyrusOne company again. But CBRE is a fantastic company, doing really well. Provides a great number of benefits. And if you just want a career like within that space, they probably offer a fantastic opportunity because they manage millions and millions of square feet of critical infrastructure. Some question about performance appraisal at the same time as bonuses. Something to Kelly to consider. Basically, the point is, can we have them closer together? I guess that's something for Kelly to think about. Can you explain why the stock price has gone from $68 per share to $55? I think I kind of explained that and went down a little lower after yesterday. I mean, a lot of it, you know, the bigger trade-off from last year heading into towards the end of the year were driven by things that were outside of our control, just, you know, a risk-off environment in the market in general. People concerned about the cloud slowing down, telecom, all the tech companies, huge you know, trades, down trades in that group. We basically got impacted by that. Our stock rallied back up beginning part of this year, and then yesterday we kind of dropped down. So as we said, as long as we execute our plan and go deliver that $1 billion and go focus on tightening up expenses around here, we're going to go drive that back up. Some of the companies that came out with you know, numbers yesterday were like up at $70 again on price. Our job is to really kind of go execute, and you know, the share price will eventually you know, come back. How do we go about job rotations? I would like to learn another part of the business. Here, this is something for you to, you know, bring up with your manager and director, whoever. You know, ultimately, at the end of the day, you are responsible for managing your career, right? So if you got to figure out what it is that you like to do, or like me, I went through life knowing what I didn't like doing, and then by process of elimination ended up in something I like doing, right? So you can come at it two different ways. So if you know what you want to do day one, you can go for it. But you have a responsibility managing your own career, and you know, make sure that your manager knows, director knows, other people know, talk to other people in other areas, and kind of get that working out. I mean, you know, a lot of things in life in general just happen through informal networking opportunities, and so you gotta go figure out how to go do that. Don't be a wallflower for anything, right? Get in the game. You know, I tell my kids all the time, like, if you want it, go for it, and don't expect it's going to be given to you. And if you're just going to sit on the sidelines, guess what? The game's going to play by you, and you know, you're gonna regret it.
So you didn't like being a CFO?
No. Oh, I don't like the CFO gig at all. It's all numbers. What is 7? This is a really long question. I feel that the current professional foreseeable wrote greater growth. We need to invest more time on reviewing and finding our workflows and processes. Currently spend an unnecessary and wasteful amount of time and effort as a direct result of communication gaps and inaccurate, outdated workflows. It would be beneficial to set up a temporary transformation cell or transformation project to review and refine our company workflows to include new projected functions, process, procedures. This would be great increase in efficiency of day-to-day operations and streamline our execution of business objectives. Nice to mention, not to mention increase the effectiveness of our customer service offerings. The objectives of the project will be processed with. You know, if we do not take the time now, it is only going to get harder as we continue to grow, and our established processes are not robust and adaptable enough to meet the operational tempo. Thank you. I completely agree with this, but I mean, just to put this in perspective, I mean, this is, you know, in a high growth company, you always have this, right? There are bottlenecks always going on in a company all the time, you know. So, you know, once you fix one bottleneck, there's another process that becomes the bottleneck. And so what you've articulated here, I completely agree with, and what we have tried to do over the years is kind of fix as many of these pain points as possible over time. You know, we've done a number of these things over the past. I mean, Granado and the team have been focused on, you know, a lot of the pain points. You know, one of my, you know, end of year ops strategy meetings with the team, everyone was complaining and bitching about everything going on. And fundamentally, when you boil it all down, it was really process. People were complaining that, like, you know, sales was doing this, ops was doing this, and then finance had to pick up all the peanuts after everyone had the party. So this happens all the time. If there's something specific about this that you brought up, bring it up to whoever. Some things happen in vacuum. If we don't know, if you don't talk, we don't know. But that said, you know, we have a number of initiatives always underway all the time, basically getting at this exact point. I am new at the company. I can't get over all the rewards and recognition programs we have in place. Very impressive for a company our size. This person deserves a raise, and get him in part of the wolf pack, you know, for sure. Look, I'm glad. Thanks for the shout outs. We spent a lot of time thinking about the team, you know, how we come across, what we're trying to do as an organization. So we appreciate the recognition. I'm kind of jaded, right? So I like working here. I like the people I work with, and so, you know, I always try doing the right thing and having a fun time, and so it's great other people see that. The corporate orientation has got to be the most informative program ever. 2 days I spent and learned more about the company in my 2 years I have been working. I am impressed by the excitement from the executives. Dinner was over the top great. Since I did not get to go to nice places in the tour of Carrollton location, wow, I was very impressed. They offered so much money to leave, but no one took it. Who would when we see where the company is headed? Great, you know, great addition there, Don. No, look, I think that's great. You know, that is a fantastic program. It is something that I enjoy going to. It is really cool. It's a good way to really kind of get up to speed about what's going on in the company right away. I mean, as those of you know, been around a long time, and this was something that Dottie originally created early on to kind of get all the salespeople didn't know what a data center was up to speed and have some semblance of being able to sell it, and then we've kind of used that and built on it to kind of develop into a corporate orientation. So, which Doan has been leading that effort for the last couple of years. So, nice job, Doan, and thank you very much, Dottie, for originally creating this idea. Because I went through it a couple times when I first joined this company, and I thought it was great. I learned a lot too, and you know, having Dottie, you know, do her, you know, her distributed redundant thing is just classic. You know, when she has the 4 distributed redundants, her each extremity, and she goes through it. It's really comical to watch. Point 10 here. I recently won a core award, which I still am so excited, but more so the notes I got from the executive congratulating me. They really care about the employees. Thanks again. Look, you know, we started that was another thing, you know, years ago we started as a way to kind of recognize good work and kind of just like kind of peer reviews about it. Because it's one of those things that you go through and you don't really, you know, most of my career, you know, no one really cared about what you did. and you know, it was always like, it was a shout out, you know, for people that you work with, you really appreciated what you did, and that was the genesis of this. Will you give the employees zoo passes? They were hitting my family. I don't know. We're thinking about this. You know, as I mentioned, we're trying to tighten up expense. Can we get special shirts when we do our volunteer work? That's something we'll also take a look at. Can we consider team core awards or some other way to recognize teams that go above and beyond? I think we have the core award. That should be sufficient. Q2, we have a lot of shout outs in this company, so I don't think we need to start any more. Q2 call, it's all but everything but love here. Q2 call, can we have something different? The company's changing. Yeah, we have had the same format from all the presenters for 4 or 5 years now. We added Hatem. It's improved. It's improved pretty dramatically in my mind. Yeah. And we got the video presentation from Tesh, so we're constantly innovating here.
So Selena told me to tell you to sit down. Because there's a video.
There's a video?
Yeah.
Oh, all right. I'll sit down now. everyone's going to go through that personal financial training program. Look, you don't need to overthink it. You want to max out as much in your 401k as we put in, right? So I don't know what our match is, but that's how much you want to do. That is just free money. Take advantage of it. Don't wait for someone to tell you. If someone matches what you're going to do, that's a good thing. We're all pretty smart. Do that. The other thing is the ESPP program is also really good. It's a 15% discount on our share price, and it's the lower rate, the beginning point or end point, right, Jackson? Right, so I don't know when these pieces, when do they start? But even like yesterday, an 8% decline, you're still getting a 15% deal. So even if that started, these are good deals to take advantage of. Even if you just bought it and then sold it, you want to take advantage of those things. That's free money on the table, and it's available to take. And compounding is a beautiful thing. If that 18% compounding, you would all retire if you put away $1,000 a month. You would be millionaires in a couple years. That 18% compounding is a fantastic thing. You do not want to not take advantage of those opportunities. Thanks, everyone. Have a great weekend. Appreciate you spending time.
See it.